Hello everyone. In this video, I will discuss provisions, contingencies, and post-employment benefits under IFRS. Contingencies and provisions are covered by IAS 37. So IAS 37 distinguishes between a contingent liability, which is not recognized on the balance sheet, and a provision, which is. A provision is defined as a liability of uncertain timing or amount. A provision is recognized for a legal or constructive present obligation arising from a past event if there is a probable outflow of resources to settle the obligation and the amount can be estimated reliably. So probable in this context means more likely than not. The term provision, as it is used in IAS 37, is related to the US GAAP concept of contingent liability in the case where the outflow of resources is deemed to be probable. So what do we mean by constructive obligation? Well, a constructive obligation arises when an entity's actions create valid expectations of third parties that it will accept and discharge certain responsibilities. For example, a company has a constructive obligation to restructure when it communicates the detail of the restructuring plan to the employees who will be affected by it. The constructive obligation concept does not exist in US GAAP, so under US GAAP, only legal obligations are accrued when criteria are met. How does IAS 37 define contingent liabilities? It says one of the following: possible obligations that arise from past events whose existence will be confirmed by the occurrence or non-occurrence of a future event, or a present obligation that is not recognized because it is not probable that an outflow of resources will be required to settle the obligation, or the amount of the obligation cannot be measured with sufficient reliability. Contingent liabilities under IFRS are disclosed in the notes to the financial statements, unless the possibility of an outflow of resources embodying future economic benefits is remote. So it's important to remember that under IFRS, contingent liabilities will not appear on the face of the balance sheet. They will only be disclosed in the section of the financial statements entitled Notes to the Financial Statements. Now under US GAAP, a contingent liability is neither recognized nor disclosed if the likelihood of an outflow of resources is remote. It is disclosed if such an outflow is possible but not probable, and it is recognized on the balance sheet if an outflow of resources is probable. So it's this third condition that corresponds to the notion in IFRS of provision. US GAAP does not provide guidance as to how the word probable should be interpreted, but research suggests that US accountants require the likelihood of occurrence to be in the range of 70% to 90% before recognizing a contingent liability. IAS 37 specifically defines probable as more likely than not, which implies a threshold of just over 50%, which is considerably lower than under current US practice. Under IAS 37, provision is measured as the best estimate of the expenditure to be incurred to settle the present obligation at the balance sheet date. If there is a large population of items, the obligation is generally measured at its expected value. If there is a continuous range of equally possible outcomes for a single event, the obligation will be measured at the midpoint in the range. And a provision will be reversed when it is no longer probable that an outflow of resources will occur. Under US GAAP, when contingent liabilities are recognized on the face of the balance sheet, they are reported at the low end of the range of possible amounts. So that's a difference between IFRS and US GAAP. IAS 37 also covers onerous contracts. So an onerous contract is one in which the unavoidable costs of meeting the obligation under the contract exceed the economic benefits expected to be received under the contract. If an onerous contract is deemed to exist, the entity must recognize a provision for the unavoidable costs of the contract. The unavoidable costs are defined as the lower of cost of fulfillment or the penalty that would result for non-fulfillment under the contract. If a contract becomes onerous as a result of a company's own action, recognition of the resulting provision is delayed until the action has actually taken place. IAS 37 also covers restructuring. So restructuring is a program that is planned and controlled by management and that materially changes either the scope of business undertaken by an entity or the manner in which that business is conducted. Under IAS 37, an entity should recognize a restructuring provision when the entity has a detailed formal plan for the restructuring and it has raised a valid expectation in those affected by the plan that it will carry out the restructuring. The cost of the restructuring must be reasonably estimable, and the plan must be carried out within a reasonable period of time. US GAAP prohibits recognition of a restructuring provision until a liability has been incurred. So the existence of a restructuring plan and its announcement do not necessarily create a liability under US GAAP. So let's move on to a discussion of employee benefits, which is covered by IAS 19. So IAS 19 covers all forms of employee compensation and benefits except for share-based compensation, which is covered by IFRS 2. Specific guidance under IAS 19 is provided for short-term employee benefits, post-employment benefits, other long-term employment benefits, and termination benefits. So with regard to defined benefit plans, the calculation of the net defined benefit liability or asset would be to take the present value of the defined benefit obligation and subtract out the fair value of plan assets. When the fair value of the plan assets is greater than the present value of the defined benefit obligation, a surplus is said to exist, but the amount of the net defined benefit asset that is recognized is limited to the smaller of the surplus or the asset ceiling, which is defined as the present value of any economic benefits that are available in the form of refunds from the plan or reductions in future contributions to the plan. Under US GAAP, there is no asset ceiling. So that's another area of contrast between IFRS and US GAAP. Now, there are three components to defined benefit costs that are reported in net income under IFRS. There's a fourth component which is reported in other comprehensive income, which I will discuss in the next presentation slide. So the first component that is recognized in net income is current service cost, which is analogous to the concept of service cost under US GAAP. Past service cost and gains and losses on settlements. So past service cost arises when an employer enhances the benefits to be paid to employees in a defined benefit plan. All past service costs are recognized in net income in the period of change. In contrast, US GAAP requires that prior service costs be recognized in other comprehensive income and then amortized to net income over time. The third component of defined benefit cost that is recognized in net income is the net interest on the net defined benefit liability or asset. So this will be the difference between interest expense, which is the mathematical product of present value of the defined benefit obligation times the discount rate, and interest income, which is the product of fair value on the plan assets times the discount rate. And IAS 19 defines the discount rate as the effective yield on high-quality corporate bonds. So in US GAAP, by contrast, you have the concept of interest cost, which would be only the first element. It would be the present value of the defined benefit obligation times the discount rate. You wouldn't have a net interest cost like you do in IFRS. So the fourth component of defined benefit cost is remeasurements of the net defined liability or asset, as the case may be. And that's reported in other comprehensive income, and it is never amortized to net income. These remeasurements consist of actuarial gains and losses. So these occur when an employer changes the actuarial assumptions used in determining the future benefit obligation or makes adjustments based on differences between past assumptions and past experience. Unlike IFRS, US GAAP allows a choice between immediate recognition in other comprehensive income or net income. The difference between the actual return on plan assets in the current period and the interest income component of the net interest on the net defined benefit liability or asset, as the case may be. So that's another component of remeasurement. And then any change in the effect of the asset ceiling during the period.